Of course, it's a big week. We have the Fed on Wednesday. Stock's not doing so much today outside of that tech-heavy NASDAQ. But you're watching the VVIX. Talk to us about what that is and why you're watching it. We actually have a great terminal of what it's doing as well.
Yeah, the VVIX is the volatility of volatility. And so what it actually measures is, sometimes when we have the market go up a couple hundred points, then down a couple hundred points, it's measuring the volatility of the actual VIX index. And so it's actually tends to be a precursor for when volatility should be picking up. And it seems like we're going into a phase here where we're actually bottoming because...
Yeah, and if we go into the terminal, we can see that, in fact, that it does appear to be bottoming to some degree with this chart that we have right here.
Right. We actually may end up seeing this may be the bottoming for the first half of the year going into the second half, because we do have the Fed coming up and we do have a lot of catalysts coming up on the macro side, right? I mean, we even have a lot of regulation coming down the pike, whether it's for big tech or not, which is 25%. So when you see it here at 83, I mean, that is significantly below where we were last year at this time, which was 105. And so that's pretty telling, considering we have a lot more uncertainty in the market.
Yeah, that's pretty interesting for sure. And also going into the Fed, you're seeing some unusual options activity relative to certain sectors. Talk to us about what sectors those are and what it means to you.
Yeah, so I like to go in and see where people are actually hedging their bets, meaning there's a little discomfort coming up that they're wanting to hedge their books. And one of the main ones is actually the industrial sector, where you saw actually in the XLI you have 5.2 times the amounts of puts being traded versus calls. Same thing with healthcare, you're having over 4 times the amount, and then also with consumer staples, which is pretty interesting because investors have gotten defensive on staples. So should the Fed actually capitulate and say they're getting easier, you may see a further dump. So they're actually probably locking in gains there. And then global uncertainty around, obviously with industrials and healthcare, there's regulation.
That's great color. And speaking of great color or calls, you've had a good call on Equinix for some time. And right now you're talking about a covered call strategy. Yeah,
I like Equinix because they're actually up over 18% since we actually started to see the volatility tick into the marketplace starting Q4 last year, October 1st. So go out and buy the stock here at around $512. You actually get to sell the 570 call against it, and then you take in about 2.34% options yield. You're getting a great options yield because the implied volatility is extremely high, 20% for a company that has performed very well, and they're a slow and stable company that just collects rents every month. So I think it's a great way to play the tech sector. It's a low vol, high yield play to play tech. You get 11% upside. I think it's a great way because if you go back to that October 1st time frame, you see the XLK is only up 0.5%, and the NASDAQ 100 is still down 2%. So stick with the winners.